I'm Jacob Milosic. I'm a tax partner here at HW, and I'm pleased to be joined today by my colleague, Nick Raycroft. Nick is one of our principals that works very closely with me in our tax group. And this is actually our third year in a row that we've done this type of personal tax update. Um, Obviously, it's kind of timely. It's hard to believe we're back here in tax season already, but hopefully the information you hear today will twig you to something that might help save you a few bucks in your tax return or make sure that you're not missing something that otherwise would be missed. Typical disclaimer, please know that what we're saying today is kind of general statements and shouldn't be construed as advice. If you do have any particular questions or specific questions, feel free to reach out to Nick or I, or whoever your advisor is at HW, and we'd be happy to help direct you. In terms of today's agenda, we're going to be talking about tax changes in 2025, and we'll see that there's not a ton of them, which is kind of a relief after a couple of years of lots of activity in that regard. We'll go through the payment and filing deadlines just as kind of a reminder. I'm going to talk briefly about something called alternative minimum tax or AMT and how that might impact you this year when it might not have in the past. Next thing I'm going to talk about registered accounts, TFSAs, RSPs, and FHSAs. And he's also going to go through what we're calling rapid fire review. So these are kind of 1 minute or 90 seconds on various topics that he'll cover off relatively quickly. We're hoping to address all of these things in roughly half an hour, and we'll leave about 10 or 15 minutes at the end for questions. So if you do have any questions as we march through, there is a Q&A section at the bottom that you can post your question or post it in the chat if you like, and we will address your questions at the end of the presentation. So with that, we'll dive into some of the tax changes. Anyone that thinks back to 2024 will remember the kind of hokey pokey year that was the capital gain inclusion rate. So it started at 50%. Then there was rules that were proposed that were going to increase that inclusion rate to 2/3 on certain types of income, certain individuals. And then at the 11th hour, CRA said, oh, you know what, we're not going to go through with this. And the rules were eventually pulled back. And we're now back in a landscape where the inclusion rate remains at 50%. So the good news here is that we've got no changes to report on this front, nor do we expect any. We haven't heard any rumblings of further changes in this regard, so kind of status quo at 50%. The second thing to be aware of is something called a bare trust and the filing requirements associated with that. There were some rules introduced in 2023 that laid out requirements for people involved with a bare trust to file a trust return. CRA then said administratively they weren't really ready to administer all the trust returns that were rolling in, and they wanted to relook at some of the rules, some of the exceptions that apply. So for 2024, they said, you know, these trust filings don't apply, and they've again said that for 2025, you don't have to bother with a bare trust filing. They've kicked the can to 2026, so stay tuned for what might be coming in that regard next year. We'll have to wait for more clarity. So you might be sitting there wondering, well, what is a bare trust? And so normally legal and beneficial ownership of a property is usually one and the same, but it need not be the case. So if you've got a situation where the legal owner is different than the beneficial owner, you want to be thinking about for 2026 anyway, that you may have these filing requirements. So for example, if I open a bank account for my son's a minor, he can't open the account himself, and I go and open it, I'm the legal owner, but he's really the beneficial owner of that account. That would be a bare trust relationship. And then further within that, there are exceptions that I mentioned to these filing requirements that may get you out of it. So for example, there's kind of de minimis thresholds that apply for small bank accounts of that nature and those sorts of things. But something you will want to be mindful of if these rules do apply to you for next year. There's been some changes on the short-term rental landscape. So as you know, as a Canadian citizen, you have to report your worldwide income, and that would include rental income, whether it's long-term rentals or short-term rentals. For these purposes, a short-term rental is generally considered to be 90 days or less. And the new rules that have kind of taken effect after a transitional period in 2024 is that if you've got a short-term rental and you're not in compliance with the municipality in which you're renting the property, you're restricted on the ability to deduct expenses related to that rental property. So, for example, the City of Ottawa requires that the landlord has to have a permit in order to operate a short-term rental, and they have to be renting the person's principal residence or primary home, essentially. And so this would be relevant, like if you own your house and you go away maybe on March break and you want to make some extra cash the week you're away, City of Ottawa will allow you to do that. So the point being is if you're illegally operating a short-term rental, now the income tax legislation allows CRA to restrict your ability to deduct expenses in that regard. And it is worth noting that CRA has published that it is the taxpayer's responsibility to keep records about their rental revenue and expenses and their ability to deduct those expenses. So they expect you now to keep provincial and municipal registration, licensing, and permits related to your short-term rental. And obviously, if they did review, they'd ask for that support to justify the claim for the expense. The anti-flipping rules are new rules that provide a bright line test on the treatment of proceeds on the sale of property. So normally when you think about the sale of a building or these sorts of things, normally that proceeds is treated as a capital gain. So to the extent your proceeds exceed your original cost, you treat that as a capital gain and you get that 50% inclusion rate that I mentioned. It can be a question of fact whether or not what that sale represents is actually business income. So if I'm in the business of buying homes, flipping them and basically selling them for a profit, that would clearly be business income. But somewhere in between, there was a bit of a gray area in terms of what was business and what was capital gain. So now CRA and finance have said where you've owned a property for 365 days or less, it's now going to be treated as business income, subject to certain exceptions. So maybe if somebody's died or somebody's gone bankrupt or these sorts of things, which required the sale of the property, well, that might be an exception. But generally, if you're within 365 days, it's business income. Why do we care? Well, number one, you're going to lose the capital gains treatment, so it's going to be fully taxable income instead of 50% inclusion rate. And the principal residence exemption is only available in respect of capital gains. And so in theory, this could apply to your own home as well, which wouldn't be a good result. So just be mindful of that 365-day test if you're buying and selling property. Some very minor changes that came into play is that, CRA is allowing for accelerated CCA. So CCA is effectively depreciation that's allowed on capital assets. So rather than deduct the full cost of an asset in year one, normally you write it off over a number of years. These new rules allow you to write off certain assets faster, which is good news for taxpayers. The other thing they've done is they've moved toward paperless correspondence for businesses, and this took effect in May of 2025. So if you do have a business account with CRA, you're maybe registered for HST, these sorts of things, you've probably noticed by now that they moved toward electronic correspondence versus the old-fashioned correspondence on paper. Some very minor credit changes to be aware of for this year. So there's something that they're now calling the new personal support workers tax credit. Rolls off the tongue. And for whatever reason, this new credit has been proposed for 2026 through to 2030. So I don't know the policy rationale of why they picked this 5-year period. But this credit will allow for 5% of eligible earnings to be claimed as a tax credit up to a maximum of $1,100 per year. And it is subject to the employer kind of certifying that the person is, in fact, a personal support worker. So if that does apply to you, it's something to keep in mind for your tax return the next few years. The other thing that's worth noting is that there used to be this thing called the digital news subscription tax credit. And the idea behind this credit is that the government was trying to support Canadian journalism. And they said, you know what, taxpayer, if you subscribe for certain online media, we'll give you a tax credit to supplement some of your costs. For whatever reason, they've done away with that credit. And so it won't be available for 2025 and future years. In the grand scheme of things, for most people, this credit was, maybe $30 to $50 worth of tax savings. So I don't see this being a huge issue, but something to note moving forward. When we look at deadlines for your personal tax return, it's due April 30th. The payment of tax is also due April 30th. That filing deadline is extended to June 15th if you've got self-employed income. The payment of your tax owing is still due April 30th. If you are self-employed and maybe you're registered for HST, you also want to be mindful of HST deadlines. Generally, those HST deadlines are going to mirror the personal deadlines, being a payment deadline of April 30th and a filing deadline of June 15th. However, if your frequency of filing for HST is different, so maybe you're filing quarterly or monthly, obviously your filing deadline and payment deadlines would vary. You've got to watch installments because although your tax payment may not be due until April 30th, if you owed more than $3,000 in your preceding year, the government's going to want you to pay quarterly installments along the way in the subsequent year. And so when we prepare your personal tax return and we give you the results at the end of the process, we normally make a point of saying, well, please be mindful of these installments for 2026. So you'll just want to kind of make note of those and follow accordingly to avoid installment interest. And we've got a note here at the bottom. We're not aware of any extensions or any other changes to these deadlines for this year. The last couple of years, we've seen extensions because of COVID and for some other reasons. But as far as we know for this year, we're working within the parameters of April 30th being the key day for tax filing. The last thing I want to touch on very briefly is this concept of alternative minimum tax or AMT. This has always existed. So this is a parallel tax calculation that runs in the background on every personal return that gets filed. So you've got your regular tax calculation, you've got your AMT working in the background. AMT only applies if the AMT number that spits out is higher than what your regular tax would otherwise be. So where we see this most often is if you've got some tax preferred deductions or credits that are being used to negate your regular tax, AMT can often come into play. Now, what changed as of 2024 is that the calculations for the AMT have been tweaked. So although the exemption has now been increased to roughly 178,000, AMT can now kick in and apply on certain types of income where historically in the past it wouldn't have kicked in. So if you're a taxpayer and your income is 178,000 or less, you don't have to worry about these rules. It's not going to impact you. This is really going to impact somebody who's got higher income. And maybe for whatever reason, you've got a large capital gain or you've got some stock option deductions, these sorts of things that kick in. And maybe it's kind of a 1 year blip and your income floats up above that 178,000. You now have to be aware that AMT may add to the amount of tax that you might otherwise have to pay. Now, if you have to pay regular tax or you can pay AMT, you're always going to want to prefer to pay AMT because the AMT can be carried forward as a credit to offset your regular tax payable in the following 7 years. So there's a 7-year carry forward period on which those AMT credits can be used and applied to offset regular tax. So with proper planning, in a lot of cases, we can ensure that the AMT is ultimately recovered, but it is something to be mindful of in the year that you've got one of these large income adjustments, because often it catches people by surprise. Where we see this most often is clients with large equity transactions. So maybe there's a large stock option benefit being reflected on their T4, and maybe the employer has withheld regular tax on that amount. People are often caught off guard because when we actually prepare the return, AMT kicks in, they end up owing additional tax over and above what was already withheld by their employer. And it's really because of this AMT. So something to watch for. With that, I'm going to turn the floor over to Nick, who's going to talk a bit about registered accounts.
Thanks, Jacob. So I thought I'd go through each of the FHSA, the first home savings account, the TFSA, tax-free savings account, and the RRSP. Each of them have their own benefits, and the reason you might use these accounts will differ, but they're all powerful tools that can be used to help reduce your taxes in the current year as well as save for a future year, whether that's retirement or hence the name of the FHSA, a first home that's being purchased. So this was an account that was created in 2023 that allowed taxpayers an additional vehicle to save money for the purchase of their first home, and it combines features of both a TFSA and an RRSP. So an FHSA, when you contribute to an FHSA, there's a deduction that you would get for the contribution. There are limits to that contribution, and you can see them on the screen there. It's 8,000. The contribution limit is 8,000 annually, or 40,000 lifetime contribution limit. In order to get the contribution limit for a FHSA, you do need to open the account, unlike the TFSA or an RSP, where those are RSP based on your earned income for the year. To get the contribution room for the FHSA, you do need to open an account with a bank and have that open. In order to open such an account, you do need to be what's classified as a first-time home buyer for this account. So that would mean you're over the age of 18 but younger than 71, a resident of Canada, and you're considered a first-time home buyer, which means you haven't owned a home, you or your spouse haven't owned a home that you've lived in that's your principal residence in the current year or in the four preceding years. So if you meet those criteria, you can open the FHSA and get that $8,000 annual contribution limit. The FHSA, it can only be open 15 years from the date that you open the account. So you do want to be cognizant of the time frame when you open the account. But for most people, uh, that time frame does allow them to save enough to buy a home. The the contribution limit, it is $8,000 annually, but up to 1 year of that can be carried forward to a future year. So if you were to open an account in 2026, you would get $8,000 for 2026. If you do not contribute in 2026 to the account, that $8,000 limit does carry forward to 2027. And in 2027, you would have up to $16,000 that you could contribute to the account. So that's the most that can be carried forward to a future year. There are penalties for all these accounts for over contributing. So it is very important that when you open an account that you are qualified to open the account, as well as watching the annual and lifetime limits so that you're not over contributing to the FHSA, because the penalty is 1% per month on the over contributed amount to the FHSA. The Next, I'll touch on the TFSA. This is, again, it's been around for a while now. But the contribution limit or the additional contribution limit for 2026, if you're over the age of 18, is $7,000. If you were These accounts were first created in 2009. And so if you were over the age of 18 in 2009 and you've never opened a TFSA previously, you would have $109,000 of TFSA contribution limit that you could utilize. The with the TFSA, unlike the FHSA, you don't have to have the account open to get the room. Once you're 18, the room starts accumulating that you can use. It is important that you track your TFSA contribution room. CRA does provide information on your My Account online for what the contribution room is. But even if you rely on that and you make an over contribution, it is the taxpayer's responsibility to ensure that they've not over contributed to the account. And likewise, again, the penalty is 1% per month that an individual is over contributed to the account. Next, in RSP, of course, contributions to an RSP would be tax deductible. The amount that you accumulate each year would be based on your earned income. So in 2025, the most RSP contribution room that you can accumulate for the following year would be $33,810, or 18% of your earned income for the year, whichever is lower. So earned income would be business income, employment income, rental income qualifies as well for generating RSP contribution room. And that RSP contribution room, that again, that can be found on your notice of assessment from CRA. And again, you do want to make sure your contribution room and limit is accurate, as there are penalties for over contributing. With the RSP, there is a over contribution tolerance threshold. So if an individual has contributed more than their limit, but less than $2,000 over the limit, there is a grace that is applied, and you wouldn't be subject to penalties if you're within that threshold. The the RSP and FHSA, those can be powerful tools when saving for a first home. Both the FHSA and the home buyers plan can be used at the same time. So the home buyers plan allows you to withdraw up to $60,000 per individual, or it would be $120,000 for a couple. And you can use that money for the purchase of a new home. You would be required to repay that $60,000 that you withdrew from your RSP over 15 years, but it does allow, the rules do allow you to take advantage of both the first home, the HBP plan within RSP and the FHSA account at the same time. So lots of information there, but all three accounts have very powerful tools to help individuals save for the future. Next, I wanted to go through about five or six just quick topics. The first one still related to real estate. The government, in as part of the Liberal election platform, they announced a first-time homebuyer rebate. Currently, there is a first-time homebuyer rebate for GST on properties purchased in Canada. The that rebate, however, is capped at the federal rebate is eliminated when the property is worth more than 450,000 when you buy it. There is a provincial rebate in Ontario, even if the property you purchase is more than $450,000. But the government did come out with the first time home buyers rebate for sales after May 27th, 2025. And so if you're paying HST in Ontario on a new home and you're the first time home buyer, they would allow for a rebate of 100% of the HST. The legislation is still pending, so it hasn't received approval yet, but they have announced that if when it does, it would apply to sales after May 27th, 2025. And that rebate will apply for both the GST and or for HST in both the federal and provincial portion for properties purchased in Ontario. If there are properties purchased in Quebec by a first-time home buyer, it would only be the 5% GST that's applicable that would be eligible for a rebate. With the first-time home buyer rebate, it's only available once. So if you've already bought a home previously, you wouldn't be eligible for this higher rebate, but you still may be eligible for the new housing rebate, which isn't limited uh, to a first-time home buyer. Next, with employment expenses. So this is, if you have home office expenses, vehicle expenses that you incur to perform your employment duties, those are deductible expenses. You do need to get assigned a form called a T-2200 from your employer that indicates what the employment conditions are for working from home. There's no longer any simplified method based on the number of days you're working from home. It is for lack of a better word, the detailed method and based on your actual expenses that you have for the year. For home office expenses, you do need to have worked more than 50% of the time from a workspace in your home for a period of at least 4 consecutive weeks. So that's one of the criteria that you need to meet in order to deduct home office expenses for 2025. Most individuals, the individuals that get the most benefit from deducting home office expenses are ones that are currently renting. Renting is an ineligible expense, but mortgage interest is not. So the individuals that are renting kind of get that benefit over the home buyers and their homeowners in this area. And it is only the amount deductible is the portion of your home office as it takes up your whole home. So if that's 10-15%, it would be a portion of your expenses that would be deductible. The next few relate to some deductions and credits. Um, Interest is a deductible expense. It does depend, however, it does depend on what you're using the borrowed funds for. So your interest that you pay on your principal residence, that's not deductible. The interest that you pay on a rental property and that you're generating rental income from, that interest is deductible. There is planning you can consider if you have a investment portfolio and a mortgage. You could consider selling your investment portfolio, notwithstanding there might be income tax on any capital gains. Uh, but sell your investment portfolio to pay off your mortgage and then take out a loan to make investments. And in that case, the interest would be deductible against the dividends that would be earned from that investment portfolio. The donation of public securities is a is a powerful tool that can be used to help increase the amount of donation credit that you have. If you think of a scenario where you have a public security worth $5,000 and you originally purchased that security for $3,000, well, option one is you could sell that security, you'd have a capital gain, and you'd pay some tax, and you'd be able to um, donate the amount of cash after paying tax to charity. That results in a lower amount going to the charity, and you've incurred some income tax on selling the share. One option is if you have publicly listed securities that have accrued unrealized gains on them, you can donate those securities to a charity. And the benefit from that is that the inclusion rate on the capital gains, so as Jacob mentioned, that's 50% when you sell. When you donate public securities, the inclusion rate is 0%, and the donation credit or the value of the donation receipt that you would get would be for the value of the securities that was donated. So you'd get a higher donation receipt and no tax on the donation on the donation. So if you are planning donations and you have public securities with unrealized gains, that is something that could be considered. Pension splitting allows eligible pension income to be transferred from one spouse to another. So eligible pension income is RIF withdrawals, RPPs, those types of income, and it can be beneficial when there's a discrepancy between the incomes of two spouses. One planning point here: RSP withdrawals are not considered eligible pension income for pension splitting. So if you have an RSP and you do need to convert your RSP to a RIF by the age of 71, but you can potentially convert an RSP to a RIF earlier than that, and that would generate eligible pension income that you could split with your spouse if it were to make sense. And lastly, the disability tax credit, or the DTC. This is a credit that This is a credit for individuals with severe, prolonged mental or physical impairments, and it's a non-refundable credit of 14% of for 2025. It's $10,000, so about $1,400 in tax savings. And there's a process that you'd go through to apply for this credit with CRA. It results in your medical practitioner would need to fill out a form, either online or the old-fashioned way, and then provide that to CRA for them to review and approve. Um, Oftentimes, individuals with mental impairments such as dementia, depression, anxiety, those allow for the disability tax credit to be applied for, or if physical issues such as they need individuals needing assistance feeding, getting dressed, if they have impairments that impact their ability to do those everyday tasks, applying for the disability tax credit and getting CRA's approval of the credit might be worthwhile. And lastly, just a few admin items to round out the day today. Uh, when you may have noticed when logging into your CRA My account, they ask you a question, like many other places, for multi-factor authentication. They have two methods. They can send you a text with a code or call you with a code, or have a passcode, passcode grid. Um, so that was recently rolled out about a month ago. And if you are logging on, you might have seen that already, but just another security measure that CRA is implementing. And lastly, as Jacob mentioned, the due dates for both personal and HST, it is important to pay those on time, as any late payments would be subject to interest, which it has gone down in the past year, but it still stands at 7% that someone would be paying to CRA for late payments of their taxes. And of course, those interest and any penalties are non-deductible. So paying paying your taxes on time, very important to avoid those interest charges that would apply. Uh, so with that, I wanted to thank everyone for joining us today. We hope you got something out of the presentation today, and we'll open the floor for any questions.
We do have a couple questions that came in through the Q&A section. And a reminder that if you do have questions you want to pose, feel free to drop those in the Q&A now. If you do have a specific circumstance that you're not comfortable raising as a question in this format, again, reach out to Nick or I offline, and happy to try and address those questions with you directly. But our first question that came in is with respect to the anti-flipping rules. It says capital gains in the 365-day rule. Does this mean 365 days between selling investment properties, or does it go by calendar year? Question mark. So maybe an example is in order. So if I buy my house on January 2nd, 2026, and I sell the same home anytime in 2026, let's say in December of 2026, that's less than 365 days. And so automatically that sale and any profit realized on that sale is treated as business income and not eligible for capital gains treatment or the principal residence exemption. So it's not based on calendar year, it's based on 365 days or less. To be clear, if in my example I purchased a home on January 2nd, 2026, and I waited until February 2027 to sell the property, I'm now outside of the anti-flipping rules, but it becomes a question of fact still whether or not this is really a capital sale, or CRA could potentially still construe that to be business income. And an example of why they might construe it to be business income is that if over the last 5 years I've done the same thing where I bought and sold homes every 14 months, it's probably indicative of that's an ongoing business transaction and not just a one-off kind of capital gain. And so it's really a question of fact if you're outside the 365-day window, but certainly inside that time frame, you've got an issue. And then the question went on to say, what about when jointly filing with a spouse? So the same rule applies whether it's jointly held or individually held. And the question goes on to say, is it 250K per person or couple? And so I think the 250K amount, maybe there's some confusion there, but the capital gains inclusion rate rules, when they originally were introduced, it applied on capital gains in excess of 250,000, the higher inclusion rate. Those rules are out the window, so they no longer apply for any rules, including the anti-flipping rules. So there's no 250K threshold when we talk about the anti-flipping rules. It's kind of, did you sell within 365 days? If yes, then you've got business income. Nick, the second question relates to the disability credit. Maybe I'll let you field that one.
Yeah. Uh, so it'll depend on the type of disability impairment that the individual has. Um, the In order to apply, there's a form, and if you wanted to send me an email afterwards, I can send you the form. But it's called the T2201 Disability Tax Credit Application Form. Some doctors will fill that can are willing to fill that in online. Some will do it the old-fashioned way on paper. I'd say it's, without knowing the further details, I'd say it's probably worth applying and seeing what CRA says. The worst case, CRA says no, and you're still in the same position you are now. So I'd say it's probably worth it to apply. One thing I'll add with the disability tax credit is that it can also be transferred between spouses. So uh, if the spouse with the impairment doesn't have enough income to use the full credit, it can be transferred to their spouse. Uh, so I did see one other question on the disability tax credit that I'll answer at the same time. Just regarding if it was received for previous years, do you need to submit any new forms to get it for the current year? Again, that will depend on the impairment. When CRA will receive the form. They'll make a decision, and they'll send you that decision in writing, or it'll be on your My Account with CRA. In that letter, it will usually state whether the disability tax credit is for an indefinite period, or it's only for a certain time period, and that'll depend on the impairment. But if you have access to your online account with CRA, and if you're a client, we can access this information as well. But you can check online for what years the individual's eligible for the disability tax credit, and if it ends in 2025, then yes, you would need to submit new forms. But if it's for an indefinite period, you would not need to submit an application again.
One other thing I'd add, Nick, just on the disability tax credit and whether or not it makes sense to apply for it. So the actual credit itself is nice, and it provides a tax benefit, but it can also allow you to do other things. So for example, somebody in their 80s who needs special care, like attending care, if they qualify for the disability credit, some of those other expenses automatically qualify as a medical expense, and that can further be claimed as a credit to help your tax situation. There's other things to consider, like the registered disability savings plan, which is beyond the scope of this presentation. But there may be other reasons why, if you think you qualify for the disability credit, it's worth doing the paperwork, as Nick says, and trying, because in the worst case, you're no worse off, but the potential savings can be significant. There's a question here about my spouse has already transferred RSP to a RIF from which he's been withdrawing. I'm in my 50s. Can he change that so that we postpone withdrawals, or is it too late? So at any time you can convert an RSP into a RIF. Once you've got a RIF, it becomes essentially an annuity where there's certain minimum withdrawals that you have to take out each year. My understanding is that once that process has been done, you can't undo the conversion to a RIF. And so unfortunately, I think for the person who asked that question, you'd be kind of stuck with the minimum annual RIF withdrawals each year. Nick mentioned possibly converting an RSP to a RIF to allow access to funds that can qualify for the pension splitting. And what I would say there is that you need not transfer all of your or convert all of your RSP into a RIF. So, if you had a couple hundred grand in your RSP and maybe you take 50 grand and move that portion to a RIF, et cetera, like it doesn't have to be the full all or nothing decision. It may allow you some flexibility in terms of income splitting with your spouse. Nick, there's a question here about FHSA contribution room, which maybe
Hmm.
I'll let you address.
Yep. Um, so the FHSA contrib the question is any comments regarding CRA FHSA contribution room records for accounts open but not funded in the year it is opened. Could CRA claim a taxpayer did not open an FHSA in a given year or never has? So from what we've seen and our understanding, if the account is opened with a financial institution, that's what's considered to have an account be open, regardless if a contribution is made in that first year or even first couple years. Like I said, there is a limit for the amount of years that an account can be opened, and that's fifteen years. So obviously, like these were created very recently. So no, at this stage, no accounts have been open for more than 15 years. But from what we've seen, even if the determination is if an account has been opened with a financial institution, even if it's not funded, it's considered to be opened um, with for the purposes of that timeline.
So there's another
And
question that came in here that says, is there an interest or penalty for unpaid tax installments? And so generally the answer to that would be yes, there is interest and penalties that can apply if you ignore your installment requirement. There's two ways to kind of calculate your installments. So for when we think about 2026, generally it's based on what you owed in 2025. So if you owed, let's say, $10,000 in 2025, generally CRA is going to want $10,000 paid in the way of quarterly installments for 2026. You can also remit on an estimate basis. So let's say you had a one-off transaction in 2025, or maybe you had a large capital gain. That's not happening again in 2026, such that you don't expect to owe tax in 2026. You can choose to ignore or maybe send in reduced installments versus what CRA has requested. And you'll only be charged installment interest and penalties if, when you file your 2026 return, you've remitted less than the required installments and you end up owing tax when you file. So in other words, if you remit on an estimate basis, you get to the end of the year and you're in a refund position, no installment interest or penalties will apply. So we've got a number of clients where they've got a one-off transaction that we actually prepare estimates for them the following year so that they're not blindly sending in way too much in the way of installments to CRA only to get that money back when they ultimately file their tax return. And then it looks like one last question. If a son or daughter lives with you and contributes for room and board, does that count as rental income? So Nick, I think we've looked at this for even more extenuating family circumstances, and I believe the answer there is that it wouldn't be rental income if it's just kind of a reimbursement to cover some of the costs.
yeah, and if it would be if the amount charged is what you would charge an arm's length tenant, you're charging fair market value rent, then yes, that would be considered rental income. But if it's just to, have them chip in a little bit, then likely no, that would not be considered rental income. And no, there's one final one just broadly about any uh, dual citizen if you're a citizen of the US and Canada. Um, we do work with a US firm and can, if there are questions there, can help. But generally, from what we've seen, it is a good idea if you are going to be using a TFSA or an FHSA to get US tax advice before those accounts are open, because a TFSA has a different tax treatment in the US than it does does in Canada. So if you are considering opening those accounts, it is a good idea to get U.S. tax advice beforehand when you're making your decision whether to open those accounts. And lastly, if you are a U.S. citizen or green card holder, you do need to file U.S. tax returns every year. So that's another, I think, thing that we come across when working with our folks in the US. So that's the last question. If Jacob and I said, if there are specific questions that individuals have, feel free to reach out to us by email or your service provider at HW Partners, and we'd be happy to discuss those with you further.
And I just want to thank everybody again for their time today, and hopefully this was helpful. If you feel you know somebody that might benefit from this content, feel free to share the video link with them. And otherwise, we'll look forward to the same thing next year. We'll see you next year.